The difference between economics and finance. A deep dive into scope and methodology. Economics and finance are two profoundly essential and interconnected academic disciplines that, despite their close relationship, maintain clearly defined, specialized focuses and distinct operational objectives. Economics is fundamentally defined as a social science dedicated to the process of making rational decisions regarding the utilization of scarce resources, including land, labor, and capital, to satisfy the unlimited wants of humanity. It is, at its core, the science of choice under conditions of scarcity, studying the complex behavior of economic agents, such as individuals, households, and nations, in the broad activities of production, consumption, distribution, and the exchange of goods and services. Economists utilize models and theories to diagnose systemic economic health, focusing on variables like inflation, unemployment, and GDP growth. Conversely, finance is a highly specialized sub-branch of economics, defined as the study and practice of managing funds, concentrating intensely on the acquisition, investment, and efficient disbursement of monetary capital with the primary and overriding objective of wealth maximization for specific entities, be they individuals, corporations, or public institutions. In terms of foundational principles, finance is robustly built upon the concept of the time value of money, the critical understanding that a dollar received today is inherently worth more than a dollar promised tomorrow due to earning potential and risk. This principle drives decisions around discounting future cash flows. In stark contrast, economics is underpinned by the concept of the money value of time, the opportunity cost associated with human effort, time, and foregone alternatives in the pursuit of maximum utility or societal welfare. The most salient distinction lies in their scope. Economics is considerably broader, concerned with the optimization of overall scarce resources to achieve the highest possible societal satisfaction or individual utility. Its questions are macro level, e.g., what policy will reduce the national debt? And micro level, e.g., how does a change in price affect consumer demand? Finance, by comparison, is more specialized and technical, focused squarely on the optimization of capital and financial assets to specifically increase profit, returns, and total asset value. Its questions are practical and application-based, e.g., should the company issue bonds or equity to fund the new project? Furthermore, economics determines the theoretical framework and behavioral mechanisms of human decision-making when faced with general scarcity, and it explains the underlying reasons for large-scale economic fluctuations, such as the causes of recessions and the flow of money, liquidity, across the entire economic system. Conversely, finance determines precisely how and where specific funds are actively managed, allocated, and strategically utilized across various projects, securities, and assets. It is heavily involved in practical risk management, portfolio optimization, and valuation techniques. It also explains specific financial market phenomena like the mechanics of trade surpluses and deficits, the intricate structure of capital markets, and how central bank policy translates into interest rate fluctuations that directly impact capital costs and investment valuation. Ultimately, both disciplines are mutually supportive and indispensable. Economics provides the necessary diagnostic and theoretical foundation for understanding societal resource allocation and resolving large-scale socioeconomic problems. Finance then provides the essential pragmatic, technical tools and strategies necessary for capitalizing on economic opportunities, achieving higher financial returns, and ensuring effective capital management within the system established by economic principles.